Hey, I hope you're doing well. So what is this revolutionary strategy I want to tell you about today? Well, it's a special strategy that gives you these results. A backtest period of around 3 years on a 1-hour time frame, BTC USDT futures pair, and this strategy gives us a beautiful, very healthy, slowly cranking up equity curve that gives us almost 150% profits. The win rate is completely insane, 80%. Same for the profit factor, 16. Now the maximum drawdown here looks quite high, but if you look at the equity curve, there's nothing that justifies such a big maximum drawdown. I believe this is computed at the level of the trades and therefore doesn't take into account the position sizing. Correct me if I'm wrong in the comments. Anyways, if we compute this maximum drawdown at the level of the equity curve, so therefore considering every time the latest all-time high versus the drop, then the maximum drawdown is of only -4%, so very low. Okay, now without changing any parameters of this strategy, let's have a look at another coin. Let's do Ethereum. And there we go. We also have a very healthy equity curve here. And this time the net profits are of almost 430%. Still a super high win rate, almost 76%, of still also a very high profit factor, 6. And now if we look at the maximum drawdown, it is a bit higher, but still very low, around -10%. Okay, and each time you can see that we have quite a lot of trades, which does make these backtests relevant. Okay, let's do one more for the road. Let's have a look at ADA. And there we go. We also have a beautiful equity curve. And this time the numbers are much higher. We see that the net profits are of almost 970% profits. And the win rate still very high, 72%. Profit factor a bit lower, around 3. And let's check the maximum drawdown. This one is a bit higher, -16%. Besides very attractive profits and low drawdowns, you can note that one characteristic of this strategy is that it is able to maintain a high win rate, more than 65% for many coins. These three were just an appetizer. By the way, this code is indeed available for free on our TradingView profile, links below, so you can do all your own testing. Now let's take it step by step. Today, I'm going to tell you how this envelope strategy works. It's an idea I got from my collaborators of the French channel Crypto Robot. So I will also discuss its strength, limitations, and also the risk management rules I've included, so you get the full picture. I will discuss also briefly the PineScript code, because I want you to have all the keys in hand to do your own modifications if you want. The very nice thing about this strategy is how simple it is. And if you're already asking yourself, is it possible to turn this strategy into a fully automated Python trading bot? The answer is yes, absolutely. And this is going to be the subject of the next video. So what makes this trading strategy revolutionary, and how is it able to maintain such a high win rate? Well, that it is because it uses one of the fundamental features of cryptocurrencies, volatility spikes. And also another characteristic is that after such a volatility spike, generally the price goes back to its average quite fast. So keep these two fundamentals in mind, and let's head over to TradingView to go through all the practicalities. I will detail precisely all the rules of this strategy when we go through the code. But first, let's understand it with the chart. So let me actually open the settings. Now, the first thing that you should notice here is that we have this price average, this white line here. And this is computed using as a source the close of the candle. You can easily change that if you want. Now, the period is also important. This is a short average, 6 here. You can easily change the numbers. And the type here in this example, so all these parameters are indeed the ones that were used to produce the backtest I've shown you just before. And here the type is DCM, which stands for Donchian Channel Midline. But you can also choose from different possibilities, more standard averages like SMA, EMA, WMA. And you can also add whatever you want in the code. It's very easy. Anyway, the important point is that once we have this price average, we displace it by a given percentage to create these envelopes here. So the first upper band here will correspond to a displacement of plus 7%. So therefore the bottom first band is a displacement of minus 7%. Then you can see that the next envelope, this one corresponds to displacements of 11%, and the final one is 14%. If you want to add more envelopes, you can easily crank up these numbers, and if 5 is not enough for you, you can totally add some in the code. It's very easy. I'll show you. And you've probably guessed it. A position is entered when the price hits a band, but each time with a fraction of the total portfolio. Let me show you some examples. This trade here, you can see that the wick of this candle came down and touched the first bottom band, and therefore we entered with a long at this level here. So remember, bottom bands trigger longs and top bands trigger shorts. Now the exit rule is, well, you exit the trade when the price hits back the Y price average that we have here. And in this case here, this happened right at the next candle, and therefore the position was exited here. Let's see how much this would have given us. This would have been winning about 3.78%. Great. Let me show you another example actually where we hit several bands. So we have one here. Let me zoom so we see correctly. Great. You see this time the candle goes and touches, the candle touches the first, and then the wick the second, etc. All these envelopes are filled in. Now, as you might have guessed, I can't enter with my full portfolio every time I touch the band. So basically you enter with the portfolio divided by the number of envelopes that you've considered. So on this entry, we engage 1/3 of the portfolio, then here another third of the portfolio, and here the last third of the portfolio. So in the previous case, when we had only one hit, that means the trade only enters with 1/3 of the portfolio. Great. So let's see how much this would have made us. So on the first one, I should start from the below here. So that's a tiny little trade. We almost break even. So around I couldn't really say, 0.2%. It could have been almost a loser, but it wasn't. Here, this one now makes a 4%. Very nice. And the last touch around almost 7%. Very nice. So that's really the game here, to catch these volatility spikes or anomalies. Anyway, I've shown you only good trades so far, but the strategy is not perfect and it does produce some bad trades. I will show you some examples when we talk about its limitations in a bit. But let's finish with the configuration quickly first. Next, you have the risk management rules, which include a stop loss given in percentage with respect to the average entry price. And this here is a special rule, which I will explain carefully when we discuss the limitations of this strategy. Then here is whether you want to choose a specific backtest period, and here whether you want to include long, short positions or not. In general, I find that the more envelopes are considered, the smoother the profit curve is, but too many will start decreasing the overall profits. Also, just be always very careful with overfitting if you start tweaking strongly all the parameters to get the best backtest results. Also, keep in mind that this video is not financial advice, it's just about me sharing my ideas. Trading always has the risk of losing capital. Anyway, are you starting to get the big picture here? This is not a trending strategy, but a strategy that exclusively relies on volatility. And with this comes the fact that this strategy really shines during ranging markets. It will work okay during trending ones, but what it really doesn't like is sudden huge price moves where they're up or down. I'll explain why in a bit. But let's briefly go through the code now so you can understand it easily, and I can also point out how the strategy addresses its limitations. In the strategy header here, importantly, don't forget to change the pyramiding accordingly if you ever choose to add more envelopes. And also in terms of trading fees, I consider 0.02%, which corresponds to the maker fees of the BitGet exchange, which is indeed where I will be releasing the fully automated Python trading bot in the next video. By the way, if you don't have an account yet on BitGet, check our registration link in the description down below. It will give you a 10% discount on all your trading fees. I did indeed say maker fees because our strategy works with limit orders. We'll see that in a bit. So first, what we have here is the configuration of all the inputs of the strategy. So first, what corresponds to the price average. So it's source, period, and type, where you see you have the several options that you can choose from. Then we get to the envelope percentages. And as you might recall from when we were discussing the settings of this strategy, you can see that I switch on by default only 3 envelopes, but you could add some default value to number 4 and 5 if you want, and also add some more if you feel like it. Then we get to the risk management, so this stop loss percentage, and then this special rule, this price jump percentage that I will explain in detail when we get to the position rules. Then this is to allow to select different backtest dates, and finally this is whether you want to enable long and shorts. So that's done with the inputs. Now we get to the calculations that are required in this strategy. So there's this little switch case to give all these possibilities to compute the different price averages, and you notably see here the formula of this Donchian channel midline if you didn't know it. Anyways, so then you get to, so indeed, beg your pardon, if you want to add some more, you can just come and add under here. Anyway, so moving on, now we're computing the band levels. So as I said, the bands, so the envelopes, are just a displacement with respect to this percentage here. So the way these are computed is the average times 1 plus the envelope percentage for the upper band, and then here average times 1 minus the envelope percentage for the lower band. Here we do just a little check to say that we will do the computation if only you have configured a percentage. So in our case, it simply says that this computation will not be done because we haven't put a percentage bigger than 0. Then we need to do something quite important here, is to compute the number of envelopes, which is going to be important to compute the position sizing, but also our stop loss level, price, etc. So this is just a little silly little kind of not loop, but if condition, is to say that everything, we set everything to 0, the number of envelopes and the stop losses prices. And if we detect that we have given a percentage to envelope number 1, then we crank up the envelope number, the count, so +1. And here, this is to compute the stop loss. So at the beginning, I'm just saying add the number of the band. The reason why the value of the band, the reason why I'm doing that is because I want to compute the stop loss, as you might understand here, as a percentage with respect to the average entry price. So that's why every time I add an envelope, I just add the value, the price of the band. And once I get to the end, I say that the stop loss corresponds to all those band values added, divided by the number of envelopes, times 1 minus the stop loss for the shorts, and 1 plus the stop loss when it's for the longs. Beg your pardon, it's the other way around. Now that we're getting to the positioning rules, we should discuss the limitations and risks of this strategy so that the rules make sense to you. As I've mentioned before, this strategy doesn't like sudden, very strong trends, because in that case, the price is not simply rebounding, but the price average will be modified a lot before the price can hit it back and the positions are exited, which generally leads to a loss. So actually, let me use one of the worst examples possible to illustrate this, and that's with XRP. You might remember that on the 30th of July 2023, a judge ruled that Ripple didn't violate US federal securities law, and that was a huge achievement in its ongoing case with the SEC. And guess what? The price pumped by more than 70, almost 75% in 1, 2, 3, 4, 5 hours. Insane. So now let's see how the strategy would have reacted without the special risk management rules, just with the stop loss. I've commented all these special rules and let's see what we get. we have this big drop that was indeed caused by this huge pump. You might tell me, Louis, that's because your stop loss is too loose. If you tighten it, it would help. Well, that's not really the case. Let me show you. So let's change it. Let's change it to 20%. So I'll put an O2 here, save, and we'll see what we get. And there we go. So we still have, it is better. It surely helps. The drop, we still have quite a big drop, but actually we have more than double the profits, and we lost about 30% on our maximum drawdown. We've improved the maximum drawdown by 30%. But this is not good enough. Why do we still have this big drop here? Well, because if you just put a stop loss, you can see that once we're stopped out, then the strategy enters again the trade, because you can see that we have our pump here, we're stopped out, but after that we can open again positions, and since this candle, the price goes through our bands, it opens again some positions, it is stopped out again here, opens again, stopped out, etc. But really, all these trades, we wouldn't want to do them. If we're stopped out at this point here, we want to stop and only allow the strategy to start trading again once the price has crossed the average. So this is what these first batch of conditions here do. So let me uncomment them, and we can do this one as well. So this one is for the longs and this one for the short. You can see that the way I do that is that it is always good to go to trade, so I can trade when good to go is true. But if I ever have that the last close trade, the comment, the exit comment is, so here this is to select the last close trade, and if this exit comment is a SL long and that the price is below the average, so here is the case of a short, so I should probably talk about this here. So if I have a last comment that is SL short and the close is above the average, in other words, that the price hasn't crossed through the price average again, then I change the good to go flag from true to false, and therefore I cannot enter the trade. So let me save, and if I save, we'll see that this will change quite a lot. And there we go. You can see that now the drop has really been reduced. So much smaller drop, the profits have been doubled. I think we've reduced still quite a big maximum drawdown, but we have reduced it more than before. And also, you do see now that we had this trade, we got stopped out. Okay, we're pausing, we're waiting until the price crosses the average to start trading again. So that's great. However, there is a caveat with that. Because when we've put the stop loss to a smaller value, to 20% instead of 40%, then we are going to be stopped out on some big wicks. So I'm showing you an example here with Ethereum, and you'll see directly what I mean. It's going to be very telling. So let me zoom in so we see things properly, and I'll reduce this. So you can see that this has now created, which we didn't have before, another big drop on our equity curve of Ethereum, which is here, this big drop. So what this was caused by this tightening of the stop loss that we just did. And basically is because at this trade here, so you can see at this candle here, which has a insane wick. I mean, these are complete freak events that you have. They're very rare. That's generally a liquidity problem on the exchange. So if we just if we compute what is the percentage change of this wick, is almost 40%. Just the wick of the candle is 40%. So that's completely crazy. But anyway, because we have reduced the drawdown, the stop loss from -40% displacement to 20%, then we are indeed stopped out on here, which gives a big dent to our equity curve. Although you can see there's a big dent, but the good thing about this strategy is that it recovers fast anyways. But so tightening the stop loss is not such a great thing. Of course, this value of the stop loss that we have here you should set it according to your margin requirements, of course. But what I want to point out, and I'm going to go back to 4 and to 40% and come back to XRP, is that we can do better, much better than that, than relying too strongly on the stop loss to mitigate the risk. There is a much better way to do this, and I'm going to show you. It's always good to have a stop loss, at least for emergencies. But with this strategy, there's something better that can be done to exit those bad trades faster without jeopardizing the overall performance. So I've uncommented everything now, and we can save, and we'll see what we get here. And there we go, bam. We have really reduced this final drop that we had here, and the profits, we've practically doubled them, almost 800%. Now, what is this rule? Well, it's quite simple. Since we don't want to ruin the possibility of entering on these very long wicks, the idea is to work on what happens with the next candle after the entry. So what I do here is that I implement a close all rule. So this is the case for the shorts, and this is the case for the longs. So we were dealing with shorts with our XRP pump. So let's have a look. So this simply checks whether we have a short position open. So if we have a short position open and the close of the current candle is actually bigger, larger than the close of the previous candle times a given percentage, so this price jump percentage that we've fixed as default to 15%, if those two conditions are verified, then I have a automatic close all that happens, and therefore I turn my good to go to false. And what you can see, let's have a look at the plot. You can see that what this does, in our case in the XRP pump, it works brilliantly. So we simply realize that we get to the new candle, and the close of the new candle turns out to be much larger, quite larger than the close of the previous candle. In other words, the price is really pumping. So if that's the case, then we exit the position straight away, and therefore we never get to hit the stop loss because we've already exited the position. And you also have noticed I also apply the same idea that once we have this close all then happens, we're not allowed to enter again the trade before the price has touched again the average. So that was the case for the shorts, but of course we have the same for the longs, but this time is we want to check whether we have a strong dump. So what we do is to check whether the close of the current candle is smaller than the close of the previous candle times 1 minus a given percentage, this price jump percentage. Great. Actually, there's a correction I want to make right now because there's a subtlety I just realized and I'm not happy with it. Maybe you also spotted it. It's got to do with TradingView sometimes has a weird logic. So basically, we have that the close all is triggered here. Great, that's what we wanted because this candle, the close is much higher than this one. However, the price at which TradingView does the close all is the opening of this candle. But that's not realistic. It should be at the closing of this candle. Or actually, when you're configuring a Python trading bot, generally, I tend to work with the opening of the candles. So this will be triggered actually at the opening of that candle here. So to do that, to mimic this, what we should really do is actually put close 1 here and then here put a close 2. Because, and we'll see, I'm just updating and we'll see the results. And now it makes really sense. Once we turn on our bot at the opening of this candle, we realize that the previous candle, the close of the previous candle was much higher than that one before. So for us, this is telling us the price is pumping too strong. So we want to exit the positions and therefore we'll do it right at that time here. There we go at this point here. And actually that doesn't change even too much the results. I think we've even improved actually the net profits. Great. So keep in mind that this strategy doesn't like erratic coins. If you have coins that show a history of often pumping or dumping by 50%, for example, in a few hours, I would avoid them. But if you really want to include them, you can play with the percent, the close all percent. Anyway, for more robust coins, these sudden jumps are rare events. We actually didn't see anything significant with our other examples, BTC, TH, ADA. But we can never prevent them from happening in the future. The good thing about this strategy is that it tends to recover fast from these drawdowns. And this close all rule is one way I found that mitigates this. But the other important aspect I want to mention about this strategy's risk management is proper hedging. What I mean by that in this context is to run the strategy on several coins at the same time. and giving each coin only a portion of the total portfolio, so that all these unforeseen rare events can be compensated. And in general, for more volatile coin, I would give them a smaller fraction of the total portfolio and spread more the envelopes. Okay, let's now finish with the strategy's rules and the code. We've covered all the risk management rules, so now we're getting to the long entries and short entries. By the way, I don't think I've mentioned this, but of course, if you find any improvement to the strategy or you have any questions, let me know in the comments down below or in our community Discord. Anyways, something I need to insist on I haven't yet is that really this strategy at every new candle puts out there all its limit orders, so corresponding to each bands. So the long bands, so the ones above for the, the ones below for the longs, and the ones above for the shorts. So you can see that what happens if we want to set these limit orders, we do a strategy entry where we indeed put the limit order, we set it to the given band, so low 1, low 2, low 3, etc. And we just check whether we have entered a percentage to do the limit. So here in our case, we have 3% that have been configured. So only these 3 strategy entries will be triggered at every candle. So you can see I've said about the limit order that is placed at the price of the band, but then we also have our position sizing, which is very important. So what happens here is that I compute that the position size should always be equal to our portfolio divided by the number of envelopes. So that's why I do times 1 divided by envelope. The 1 dot is just to have a flow conversion in case n envelopes is an int, which I think it is. Anyways, so one little subtlety that is important to consider here, quantity needs to be given in the base currency. So that's why I don't just give the strategy dot equity. I divide that by the price of our asset, which at this entry here, for this entry here, it will be equal to the given band. And then you update that, you change that to the corresponding bands each time. So great. So that's how this works. And it's the same for the short, but reversed. So you will have now it's the band highs, so the higher bands, and I'm dividing therefore to do the conversion by the high bands, but basically it's the exact same kind of philosophy just for shorts. Okay, now we get to the exits. So same kind of idea, you only want to place those exit orders when we have given a percentage, so that's why I have all those ifs as well. And you can see that the exits, we always have 2 types of exits that we set. The limit, the standard one that we want when the price goes back to touches again the price average after entering a position, then we have placed our limit order. So that's the limit order for the exit condition at the level of the price average. So this is updated at every candle as well. And we also put a stop loss. So that's our stop loss here that we give at the stop. So stop equal to stop loss longs for the long case, and stop equals to the stop loss for the short case. And just my nice little comment loss. Remember, this is quite important in the strategy to have the comment loss so that we have those exit here, our flags that are turned on and off correspondingly, like this and like this. Okay, anyways. So that's that for the exit. So far, so good. Then we get here to the plotting. So very easy. Just note that I've commented, but if you want to plot your stop loss levels when you're experimenting, you can uncomment here. And then finally, this is our order computation for the analysis table. So that's the table that we had, this nice little summary table that I displayed here. You now have all the elements to do your own testing and modifications. I will present how to install a fully automated Python trading bot with this strategy next time. So stay tuned if you're interested. And when it's ready, it will show up here. Thanks for watching and take care.